because I just believe capital can do more than just create alpha. You can look at the burgeoning ecosystem of sustainable finance, green bonds, social bonds, blue bonds, as demonstrations for how investors can capture both the impact alongside the financial return. You don't close that funding gap exclusively through privates. You need all markets participating in mobilizing capital towards those solutions.
Matt, welcome to the show. Thanks for coming on today.
Great, Scott. Thanks for having me.
It seems that Rowe Price has put you in charge of answering a very specific question. And I think that question is, can we use one of the world's biggest active bond platforms to do some serious impact investing and do it at scale and do it without giving up on financial performance? But before we talk about all that, I'd like to start today at the beginning. And I find that a lot of interesting investors often have early formative experiences that shape how they see the world. So take me back to the beginning. Where did you grow up? Tell me about your family, your parents, your siblings, if you have any. And what was your childhood like? Paint me a picture of young Matt Lawton.
Great. Great. Let's start there. So I was born and raised in a town called Frederick, Maryland. It's a suburb of Baltimore and Washington, D.C. Historically, farmland. I wasn't going out cow tipping when I was growing up, but there was a fair bit of farmland in the areas around where I grew up. My parents both worked in public sector. My dad as an accountant for a county government, and my mom as a public school teacher for a number of years before working her way into administration. Grew up as an only child. I'm an only child, but no shortage of friends growing up. Growing up in Frederick was going out to play outside when the sun was up, and then when the street lights came on, it was time to come home and go for dinner. And we lived outside. We didn't have phones growing up in the 80s and 90s, and it was a great time. It was a great childhood experience.
Were there any early influences, the teacher who might have said something that stuck with you, or a family member who modeled a particular way of thinking, and that might extend to risk or fairness or how the world works, things that maybe you can see now showing up today and how you think about capital and allocating capital?
Well, I think, my first introduction into finance actually came in fifth grade, believe it or not. And I've been nerding out on it kind of ever since. We were doing this simulated stock market game where each student would pick a number of stocks to own in a fictitious portfolio. And I recall some of the stocks that I picked were like Topps baseball cards, because I collected baseball cards growing up and took great interest in that. I think I also had like Disney because I liked the Disney movies. And so it was the idea of owning companies that were of great interest and personal relevance to me was something that resonated. And I remember when we played this game, right, we had the stocks on paper, and then next morning I'd open the newspaper to the business section to look at what did the stocks do the previous day. Obviously, things are quite different now in terms of how we track and record price movement. But that idea was something that concept of investing and following trends and was something that resonated with me pretty early on and has stuck ever since.
That's an interesting assignment for the fifth grade. And getting up in the morning as a fifth grader and rushing to check stock prices is not normal fifth grade behavior. How'd your portfolio do?
It was funny. I was actually looking at an exercise that I still have some records on this, actually. So I looked of the 9 companies that I had in this fictitious portfolio. I think 4 of them still exist. I'm pretty sure phone.com doesn't exist anymore. Lucent Technologies, I think MetaMune, and there was maybe one other one in there too. So it's a good thing I didn't go into a career picking stocks and stuck to bonds instead.
Topps, that was one of your 9 companies?
Yeah, I think so. Yeah, it was. Yeah.
I actually remember not that in somewhat recent memory that was still a company. I think a friend of mine was going there to be CFO or something, but probably baseball cards is probably gone by the by. What was it about that experience picking equities that made you want to work the rest of your career in, wait for it, fixed income?
Oh, yeah, that would be tough to connect that. But I do think it was just this idea of the concept of owning a piece of a company was something that was just really fascinating to me. It's like as a fifth grader, 11-year-old, like, whoa, I own a percentage of this significant enterprise that we all experience and live with and interact with on a daily basis. And that idea of investing was something that resonated. And then also the very transparent, for lack of a better word, attribution. You can see on a day-to-day basis what your performance and how your portfolio is performing. So having that real-time feedback was something that was really interesting. The transition to fixed didn't come until much later in my career, really until after university when I got introduced to credit.
It just kind of started out so young. What kind of school is this? I mean, that you have a fifth grade class picking stocks?
It was a very small, like I said, kind of rural public school. But we just had this one special project where this was to introduce stock market to us. And I was fortunately able to continue with that sort of finance education, even through public middle, public high school. In high school, I did this program called Academy of Finance, which was 2 years, half a day every day, where we did, lessons on econ, accounting, finance, marketing. And it was really that experience which really kind of formed the foundation and interest for pursuing secondary education in finance.
That's extraordinary. It's quite young to be captivated by that. So in 2001, you head off to Boston College to study finance. So why BC? And at that point in your life, was finance always the plan, or were there other paths that you were considering?
So yeah, when I was looking at colleges, it was a couple of things I was looking for, and BC kind of ticked a lot of the boxes. One, I was looking for a Jesuit university. So my uncle is a Jesuit priest, and the philosophy that comes from Jesuits in terms of emphasis on education, service to others, and intellectual curiosity, those were all concepts that really resonated with me and my desire to continue to learn. So I was looking for Jesuit universities. I was looking for universities that did have a strong finance program because I did have that intention. And then I was also looking for schools that had a decent sports program too, because I wanted to have that experience in college and to be able to not just have fun, not just enjoy the academics and learn, but also have fun and watch some good sports. And during my time at Boston College, I became, as a Jesuit university, one of the things that really kind of resonated with me on a personal level is social responsibility and service for others. And so I made the decision to take up a minor in philosophy while I was at BC. So I majored in finance, but also minored in philosophy. And why I think that had an application into finance and into business ethics was really, I think, wanting to have a framework for understanding what fairness looks like in business and in a broader finance context, balancing profit motives with broader social responsibilities. And I think that education, that mindset also was, somewhat deep and embedded within me that helped inform and my enthusiasm for ultimately pursuing a career in impact investing.
Was that specifically in a philosophy class, or would you say that was overall embedded in the BC, education?
Very much embedded in the BC education. Coming from public elementary, middle, and high school, I didn't really have structured learnings in philosophy or theology, whereas in the BC curriculum, it's very much a liberal arts education for the first couple of years where you're learning all of these broader disciplines. And then only after, a couple of years do you start to focus more on your major of choice. And so it actually was an introduction to philosophy class that spurred my interest. It was specifically reading Aristotle and Plato. I think those philosophy and moral frameworks were something that spoke to me. And that was something, so I decided to pursue that through a greater discipline, took a number of other philosophy classes to learn more about it, really kind of more just from a curiosity perspective. But I think also there was an alignment between what I was learning in those classes and then how those learnings could be applied in life, in finance, but also more broadly in life.
But then it lay dormant for about 20 years until T. Rowe Price asked you to start the impact fund.
And then boom, it was awoken. Let me call
like
back
a zombie.
Nicomachean ethics and how can I build a portfolio that is consistent with these principles. I was in Boston from 2001 to 2005, which was a really exciting time to be in Boston from a sports perspective. The Patriots won 3 Super Bowls. The Red Sox won a World Series for the first time in 86 years. And so it was a lot of fun to be in Boston for the time.
Historically, you were there at the right time. So then after graduating from BC, you land right in the deep end of traditional finance as an associate in the investment banking division at Barclays Capital in New York. Tell me about your experience there.
Yeah, so I'll just maybe rewind for a second, because during my BC experience, I did a study abroad program where I was in London for a spring semester. And what was really cool about that experience is I did an internship at Citigroup in their emerging market loan capital market desk. And so this was really my first, I was thrown in the deep end here when it came to iBanking and capital markets and finance, but it was really an eye-opening experience, just to kind of see how capital markets were working on a global basis, to work with people from all over the world. And it was that internship experience which planted the seed and interest in pursuing a career in investment banking. And so when we went through the recruiting cycle at BC, Barclays was just the bank that really, I thought was a really good match from a cultural perspective. Going through the interview process, I felt like I had a good cultural alignment and with the individuals that I met. And so I was really enthusiastically pursuing that option. And then from there, it was kind of a little bit of a different pivot. I was working in power and utility investment banking. So specifically looking at loan underwriting, debt underwriting. At the time, Barclays Capital was a real powerhouse in the debt business. And so our focus and my focus at that time was trying to underwrite deals for the power utility sector.
Were you an analyst, or what were you doing?
I joined the firm as an analyst, 22-year-old, and worked it up my way to associate. And in that analyst role, I was charged with putting together loan memorandums to be able to basically make a business case for why we should be lending to certain utility companies, and looking at what the return on capital would be from certain transactions, and then what other products and services could we cross-sell into that client, whether it was bond underwriting or FX or collateral management, and really trying to get a sense of the whole picture and how we could partner with a client to help them raise capital, but also be that partner of choice on other financial service activities.
And they gave you the pleasure and the opportunity to work all night and all weekend.
Yeah, I don't know how much it is today. From what I hear, the culture hasn't changed a whole lot, but for sure there was, it was pretty common to work 6-7 days a week, often until midnight or later, and then you're clocking in early the next day. I can't say I necessarily benefited from all those, from the FaceTime of being in there just to be there. But like any job, you get out what you put in. I put a lot in over those 3.5 years, and I got a lot out of it. And I think it helped serve me to a greater purpose down the line.
So then we get to around 2009, and that puts us about in the teeth of the Great Recession financial meltdown. You decide to leave Barclays to go study for your MBA at Georgetown. That's pretty interesting because you're already working at a decent level in the world of finance. So what were you hoping an MBA would do for you at that point, and how did you arrive at the idea to go to Georgetown specifically?
As you mentioned, Scott, there's a lot going on in the world in 2008, 2009. And at the time, Barclays had acquired the investment banking business of Lehman Brothers. And so overnight, the Barclays Bank or at least the investment banking division of the bank, had moved over to the Lehman office. All of a sudden, I went from a team of, say, 7 or 8 bankers to around 25 to 30. So that was an adjustment. And then we had all the backdrop of everything that was going on in financial markets. I looked around. I think I was one of 15 associates. So I was at a post-MBA level already. But I was one of maybe 15 associates on the power and utility team. And I was the only one without an MBA. So I looked around and said, I'm not so sure this is probably going to be the right long-term team and fit for me. Let me go see where I can hide out for 2 years and maybe see what else I want to do with the rest of my career. So the light bulb moment when I was like, oh, maybe I should apply to business school. And Georgetown was one that rose to the top for me for a few reasons. One, it's a very global school. So it draws in students from 46 countries. I think having that global perspective, that global mindset is really important in all things, but especially investing. And there was actually a really cool assignment that I was able to do through the MBA program where we did a consulting project for an international company. The location was of great importance to me too. I grew up in Frederick. They're still my best friends today. My wife, who I went to high school with, grew up in Frederick. My parents, my in-laws all live in Frederick. And so I was very intentional about finding a program that would hopefully land me a career in that DC, Baltimore market. And then the last reason I think for pursuing an MBA more generally is wanting to diversify my knowledge base, wanting to expand my skill set from just, focused and concentrated in finance to things like marketing and strategy, and communication, because all those things obviously carry great importance.
And during that MBA program, you had two internships. The first one was at T. Rowe Price's fixed income division, which seems to be prescient. And then after that, you did something with the Carlyle Group in private equity. Tell me about those internships and what were your big takeaways from those?
Yeah, the T. Rowe Price internship was such a fantastic learning experience. And obviously, I'm still here. During that summer, I was given a coverage assignment, as you say, within the fixed income division, but specifically within emerging markets, credit research, and specifically Latin American utilities. So it was a sector I had familiarity with, covering power and utilities on the banking side for 3.5 years, but knowing not a whole lot about the LATAM utility market. And I remember when I joined for my first week, my mentor came to me and said, okay, here are the 10 companies that are going to be within your coverage assignment. Go out and find some good ideas. Go out and help us make money. And I remember that assignment, that challenge, was both equally liberating because there was a great degree of freedom that they were affording me to go out and find those ideas, but then also at the same time terrifying, right? Because when I came from the banking background, I was used to being in a very structured team, a very structured environment where everything is very hierarchical. I come to T. Rowe and it's basically here, as an analyst, you're basically given the autonomy and freedom to go out and find ways to make money for our clients. That was a great experience. I remember going to Brazil for a week to meet with companies and regulators and development bank officials. And then at the conclusion of that internship, presenting to the wider fixed income division on my investment recommendations. And fortunately, was fortunate enough to be offered a full-time position off the back of that internship. The Carlyle internship was one that I pursued concurrent with the MBA program. Every year, the Carlyle Group would select 2 to 3 second-year MBA students out of either Georgetown or Maryland to come work in their growth buyout division for, it was 10 weeks during a semester, just to get some experience into the world of private equity. I never candidly had a lot of interest to pursue a career in private equity, but I did have interest in learning about it. Yeah. And so this abbreviated internship afforded me that opportunity.
So when you get to the end of this, at that point in time, you would have worked at investment banking, did a brief stint in private equity, and then you spent time in traditional fixed income. How did you see what the significant differences were between how your brain works when you're evaluating risk in private equity versus iBanking versus fixed income?
Yeah, that's a great question. I think iBanking is definitely more transaction oriented, right? You're always kind of working on what's the next transaction that you want to get mandated on, and then you finance that deal, and then you look to the next deal. It is an environment where you're constantly pitching for new business as well, and so that grind was not something that was something I really wanted to pursue over the long term. When I got to fixed income, and particularly T. Rowe Price, one of the, I think, distinguishing characteristics of this culture of this firm is that it's very long-term oriented. So when we're making investment decisions, be it on the stock side or the bond side, you're doing so with a very much a long-term investment horizon in mind. And so having that mindset was something that really resonated with me. And then I guess on the private side, one aspect of that job that maybe didn't appeal to me so much was you're constantly also looking for the next deal. You're constantly looking for what could we originate, what could we kind of find out in the market. And then, so that sort of transaction specific approach was something that maybe didn't appeal to me as much as what I experienced on the fixed side.
You had a good view of the horizon from there. So in 2011, you got out of Georgetown, you joined T. Rowe Price as an investment grade corporate credit analyst. I guess you just answered what the pull was to come back.
Yeah, I think that was certainly a pull. And one other thing that came to light during my internship experience is, and one of the reasons I wanted to join T. Rowe was also the culture of learning, the culture of being respectfully challenged. I learned pretty early on in that internship experience, and it still holds true today, is that I benefit from working with people that are a lot smarter than I am because they help me become better investors and better communicators, better risk managers. I think as the time has passed, I've been here 15 years, the ratio of people that are smarter than me continues to increase, but yet still here. Hopefully my boss isn't listening to this and it doesn't realize that, but that's something that drew me to T. Rowe and has helped keep me here.
You came in as a credit analyst, but then eventually you became a system portfolio manager of U.S. investment grade credit. Was that something you lobbied for? Did someone tap you on the shoulder, or how did that come about?
It was a bit of both. So my research coverage when initially joining as an analyst was in healthcare. At the time, healthcare was perceived as a very sleepy, high quality sector. So they thought, okay, here's a sector Matt can't screw up. Let's give him something that's nice and easy. And then we had this kind of multi-year, multi-billion-dollar M&A wave. There was a lot of volatility happening in the biotech sector. And so it became a pretty interesting sector to cover from an analyst perspective. And I got a lot of great opportunities to provide alpha for our portfolios. And then from there, I raised my hand to cover the financial sector. So I covered regional and Canadian banks for a few years. And the reason I raised my hand for that is because I think to be a good, well-rounded investor, to be a good portfolio manager, you need to have experience covering the financial sector because banks are such an important component of fixed income benchmarks. You need to be able to know how to analyze balance sheets and income statements and capital ratios, et cetera. So did that, the analyst coverage for, as you say, around 5-6 years. And then I expressed interest in pursuing a career in portfolio management. And fortunately, that aligned with an opportunity on the team. So for those 8 PM years where I was an associate PM in investment grade, I was still covering credits. And then I was also supporting our PMs in our US IG and global IG business. So I was doing 2 jobs, neither of them particularly well, but I was at least getting some experience into the PM work and getting those reps into what it was like to manage portfolios.
Fast forward to late 2021, T. Rowe Price asked you to create their first fixed income impact fund. Until now, I think you were a portfolio manager, was pretty much plain vanilla bond investor. And throughout this rather long career, we haven't heard the word impact once or even responsible investment. So you ended up creating and launching what becomes the Global Impact Credit Strategy. Was this something they told you to do, or was this an idea you had, or somewhere along the line did you get attracted by the development of the impact market or responsible investing? Tell me about that.
Yeah, my story is probably a little bit unique relative to some of the other guests that you've had on in that impact found me. So it was a case in 2020, our head of fixed income asked if I would consider taking on and building out, as you say, an impact fixed income capability. At the time, my book of business within the U.S. investment grade corporate bond book was around 12 to 15 billion of AUM, which I know is maybe not a lot of money to, especially the people that you've had on this show, Scott, but that was and is a lot of money to me. And I'd say probably despite against my better sense of judgment, as well as prospects for future job security at T. Rowe Price, I made a decision to give up those assets and give up those responsibilities because I found pretty early on to do impact investing with integrity, it took a full-on commitment to the cause. So when I was asked to consider this, I'm a research analyst at heart. So the first thing I did was research what this market and what this opportunity could look like. And as I was undertaking that research, there were really kind of 3 things that came to light and which informed my eventual pursuit of this career path. The first is that, as you start to research around the UN Sustainable Development Goals and the environmental and social pressure points that present, you can see that there's a real need here for investment, right? I mean, I think the SDG funding gap is on the order of 2 trillion plus per annum. So 1, there's a need. 2, the global bond market as the world's largest securities market, I can think of no better market that's well placed to facilitate capital flow from asset owners and investors to issuers and projects that are helping to address said pressure points. And then the third, and this is just where Matt Lawton's personal belief towards investing comes in, which is I just believe capital can do more than just create alpha. We've been doing the alpha part with reasonable success at T. Rowe for 90 years. And I think alongside that, you can look at the burgeoning ecosystem of sustainable finance, green bonds, social bonds, blue bonds, as demonstrations for how investors can capture both the impact alongside the financial return. So I think having that dual mandated approach is something that resonated with me. I'm a dual mandated human. I think you can, pursue both and should pursue both. So I think it was that alignment which really got me excited and enthusiastic around the opportunity.
What was going on at the company that this idea percolated somewhere else and then they came to you and said, can you do this for us?
Yeah, it was an alignment between, where we saw opportunities in the market, where we saw interest and demand from our client base. And we were seeing a secular trend of clients wanting more, kind of just broadly speaking, intensive application of sustainability in their asset portfolios.
Right.
So we saw one was it was being client driven. Also within the company, there was work underway to develop an impact equity strategy, a global impact equity strategy. And so we saw this as a really good opportunity for fixed income and equity to be on kind of this similar journey and to do so with a shared foundational framework for how we define and qualify impact within public bonds and public stocks.
Fill out the end of the picture here. Less than a year ago, you became the head of impact fixed income at T. Rowe Price, managing, I think, 3 different strategies. And how did that progression happen?
So as you rightly point out, that specific title designation is a new addition to my resume. I had basically just been a fixed income impact portfolio manager since 2021. And then since that strategy launched in 2021, we've started to scale assets and grow some density in the business. So the idea around having sort of a designated impact fixed income team was properly resourcing this effort in a manner that we could hopefully then scale it, even further going forward. All that means is I help manage the impact portfolios. So across the 3 strategies, global credit, short duration, and I have a co-portfolio manager on an emerging market blue bond strategy as well.
Most everyone listening has heard of T. Rowe Price, but just to get into this, give us the 30,000 foot view of the firm, and then where does fixed income sit within the bigger firm, and then zoom in on exactly where impact fixed income fits within fixed income piece of the company.
Right. So T. Rowe Price is a 1.8 trillion active asset manager with an emphasis on bottoms up fundamental research driven investing. We were one of the early innovators in the retirement space with the target date product, I think was launched in 2002. And so around 2/3 of our assets sit within the retirement business. So your 401ks, et cetera, of the world, where we're hoping to provide better investment outcomes for those clients. Fixed income is around $330 billion within that $1.8 trillion company level. And it's grown, the fixed income business has grown quite a bit. We were $260 billion 2 years ago. And so it's been a real sort of point of emphasis and growth for the firm. And then impact fixed income is but a small piece of the overall fixed income business, but it's one that's been growing at a really nice clip over the last couple of years.
What is the amount of assets under management that you identify as impact?
It's within fixed income, it's around 2.7 billion of dedicated impact strategies that I have management of.
Okay, so you got a way to go before you conquer the 300 plus. What is T. Rowe Price's actual theory of change around impact credit? And what is the fundamental underlying belief about how deploying capital in this way creates change in the real world?
So I would say, our impact approach is really grounded in those principles of intentionality, materiality, measurability, and additionality. And so everything we do is sort of anchored around those principles. But I think within the bond market, right, I think the 2 things I would say, one is, obviously through the use of proceeds format, we're able to have a direct connection from our capital to specific projects. And then hopefully those projects are delivering specific and measurable outcomes. And then also another way that, we think about delivering impact in public fixed income is through stewardship and engagement. And so working with our portfolio companies to either accelerate impact, manage negative risks, or even things like help structure new transactions to mobilize new capital into impact projects.
Who are primarily your clients that are invested in these strategies?
So it's typically clients where there is a dedicated book of sustainable or impact investing. So it could be, we sit on a number of platforms in the UK as well as in Europe, where there are model portfolios that allocate across impact equity and fixed income strategies. So we sit on a number of those platforms and get share from those clients. We also have an institutional business where we manage money for European pension fund that is managed in a global impact credit inspired philosophy, but with a bespoke sector allocation. And then 2 months ago, we announced a launch of a strategy that focuses on emerging market corporate blue bonds. And there's a number of anchor investors that were named in that strategy, which includes the likes of IFC, Builders Vision, as well as Xylem.
So you've got a suite of impact strategies. You've already mentioned them. I guess it's global impact credit strategy, global impact short duration bond strategy, and the emerging market blue economy bond strategy. Can you walk us through each one at a high level and what's the problem each one is trying to solve and for who?
Global impact credit, that was the first strategy that we launched in December of 21. So that is a global corporate credit strategy that endeavors to deliver both environmental and social impact. So it's broad in its impact approach. We have 2 impact pillars, 1 environmental, 1 social, and then 3 sub-pillars that sit within each of those broader pillars that really kind of focus and ground our intentionality in terms of the type of impact that we're endeavoring to deliver. The global impact credit strategy, it's a 5 to 7 year duration, high BBB, low single A type strategy that endeavors to provide excess return in excess over a broad-based non-ESG benchmark, in this case, the global credit benchmark. Global impact short duration is a bit of a unique story in its origin. This actually dates back a couple of years ago when a UK impact client came to us with a problem. That problem was they were seeking a short duration, high quality impact bond strategy that could sit within their platform and provide basically impact and income in kind of a sleep at night capacity. And so we worked with them to design this strategy and then eventually launch that into the market in March of 2024. So it is grounded in the same principles of global impact credit, but as the name would suggest, it's shorter duration, 1 to 3 years, and also higher quality. So think kind of high single A, low double A type credit quality. And then the third and most recent iteration is the emerging market blue economy bond strategy. There's a whole other origin story that sits behind how this strategy came to be, but essentially what we're trying to do with this strategy is mobilize as much capital into the blue economy within emerging markets, consolidate standards in what is still a very nascent blue bond market, and then provide a compelling target return for our clients.
So within these strategies, what instruments are you actually investing in? Is this all green bonds, social bonds, sustainability bonds, blue bonds? Haven't heard orange bonds mentioned from you, but I know they exist.
Yes, see what other colors of the rainbow we can come up with. I wouldn't put it past the bond market to come up with new innovative ways to describe what they're financing. But in our impact strategies, we invest in both labeled as well as non-labeled bonds. And this was a very intentional decision when we were designing the strategy and the product in those early years. We considered going just through labeled bonds, but then we thought, well, there's this whole universe of companies that are mission impact aligned, that are providing positive impact that we can measure. We can look to revenue, profit, CapEx as ways to signify how much these companies are investing into impact solutions. And maybe they don't all choose to finance themselves with a green bond or a social bond. So examples would be like pure play renewable developers or not-for-profit pediatric hospitals. So we'll invest in these companies through non-labeled format, assuming we can underwrite them consistent with our impact framework.
But in terms of the other, you do green bonds, and what are the other labeled bonds, or do you invest in all the labels?
Yes, we do invest in green bonds, social bonds, sustainability bonds, blue bonds, orange bonds. We have very small percentage invested in sustainability linked bonds. We've been very skeptical of that format for a number of years and for a number of reasons I don't need to get into, but those do represent a small portion of the portfolio, and we will invest in them when it makes sense, really more from an issuer perspective, more so than a format perspective.
There's definitely going to be some listeners who don't live and breathe fixed income. So can you just very briefly break down how these different instruments actually work in practice?
Sure. So green bonds is probably the more familiar concept out there. It's like a $4 trillion plus market. And in green bonds, proceeds from this raised capital are being allocated to a broad range of environmental projects. And these environmental project categories are defined by ICMA, the International Capital Markets Association, and specifically the green bond principles, which outline the eligible project categories that could qualify for a green bond. So it could be things like energy efficiency, green buildings, renewable energy, marine conservation, all sort of broad environmental type projects. Social bonds are similar in concept, except they're being allocated to specific social projects. So think of things like affordable housing, essential services, job creation, things that are providing a measurable social impact. Sustainability bonds that pull in from a mix of both green projects as well as social projects. So it could allocate across both of those, and it's done so within one particular transaction. Orange bonds, consistent with the SDG 5 of gender equality, which is the orange colored SDG, are endeavoring to provide financing for gender lens investing. So it could be, for instance, a bond that finances women-led SMEs and sole trader proprietorships that are hoping to spur job creation and mobilize capital towards underserved parts of the market. And then lastly, just to cover it off, blue bonds are a subset of green bonds in that they fall within the broader green bond principles categories, but are distinct in that they allocate 100% of proceeds to projects that are aligned with UN SDG 6, clean water and sanitation, and or UN SDG 14, life below water.
Let's talk about culture for a second. T. Rowe Price is a global active asset manager with a performance-driven culture. Not that that's inherently bad, but it does create a certain set of expectations. You've identified your relatively small piece of the pie at this point. How do you balance impact objectives in that kind of an environment? And what are the tensions and how do you navigate them?
So there's always going to be some tension that we encounter if we're underwriting an investment we're essentially underwriting across two dimensions, right? Because the first is we need to get comfort in underwriting clarity on the impact thesis. And there are defined frameworks that we have to carry out that underwriting. We specifically use a 5 dimensions of impact framework with the theory of change for every investment. And then also we have an ESG bond evaluation. So if we're looking at a labeled bond, for instance, we have a separate framework that we put that bond through to determine its credibility and ambition. But really the way I think about, delivering value and alpha in an impact context is we do it with the same principles, except we just do it in a more narrowly defined universe. So my benchmark, global credit, has, I think, on the neighborhood of 2,700, 2,800 issuers in it. When I apply our impact materiality assessment, our requirements are that a company needs to either have greater than 50% of current revenues aligned with environmental or social impact, or it's the use of proceeds bond. When I apply those two alignment filters, the universe gets down to around 900 or so issuers, so around 30% of the benchmark. And then when we carry out those more intensive aspects of impact underwriting, the universe gets smaller and smaller. But the characteristics I'm looking for in that pool of investments is no different from the characteristics I was looking for when I was managing IG corporate portfolios. I'm looking for good yield and spread on offer relative to value, relative to fundamentals, but I'm doing it with a more discerning and defined impact filter and impact lens.
I'm really interested in having this discussion because obviously impact's been growing, by double digits for quite a number of years now, but it still represents a relatively small percentage of assets under management worldwide. And the problem with impact always is scale. From day one, that's always been the issue. If we're really going to have big impact, we've got to scale more. Fixed income market is the largest public security market. So I get this question all the time, and I'm curious how you would answer. Most people associate impact investing with private equity. A lot of people say to me, if you're buying and selling bonds on the secondary market, how does that actually drive positive impact? What's your answer to that?
First, I would completely agree with your earlier comment, and maybe just to contextualize the role that public fixed income can play, right? Because as I mentioned, there's a massive funding gap, right? That presents as it relates to the UN Sustainable Development Goals. You don't close that funding gap exclusively through privates or exclusively through venture. You need all markets participating in mobilizing capital towards those solutions. And I think we've done a good job sort of progressing the mindset to accept public fixed income as a viable channel for impact investment. The issue that you raise in terms of secondary trading is one that I often get asked a lot. And you know what? My answer is, I'm not sure there is impact to be generated from buying and selling bonds in the secondary. I think you could maybe make a link or an argument that, okay, maybe you're buying a bond in secondary, and by extension, you're maybe reducing the cost of capital for the issuer. I think that link is a little tenuous, to be honest. So for us, if we're buying a bond in the secondary market, and we have this requirement for every investment, ex ante, we need to identify what is our investor contribution to the impact outcome. And there's two ways that we can defend that. The first is through primary capital provision. So very clear, finance a project, gets funded, and we can link our capital to that outcome. And the second is through stewardship. So if we're buying a bond in the secondary market, we need to identify any number of topics that we are going to engage with that issuer on to advance or progress the impact thesis as we see it. So an example could be we buy a green bond that's only maybe been 20% allocated. So it still has 80% more to go. We buy the bond in secondary, and then we engage with that issuer to provide our guidance and feedback on where we would like to see that remaining 80% allocated and why, and how we would measure the impact from that allocation.
So what percent of your portfolio is new issuances versus secondary market investments?
It's probably around 60% primary. Now, remember, when you're managing a daily liquid vehicle, you get flows in and out. So if we buy a bond at new issue, but then we get a big inflow the next day, we got to buy some more of that bond, and that purchase is done in the secondary. So it does tend to oscillate over time. Okay. And then obviously when you launch a strategy, it's 100% secondary, but then it becomes more primary over time.
Yeah. Well, let's get more specific about how you define what impact actually means in the context of mainstream credit. And how do you balance that definition against performance and investability? Because I imagine there's deals that look impactful on paper, but don't really work from a credit perspective and vice versa. So talk me through that logic.
So the impact underwriting, kind of as I mentioned earlier, is if we're looking at a particular issue or a project, we'll effectively build an impact model on that company. And we use the 5 dimensions of impact framework to help provide that overall assessment. So, what is the outcome we're hoping to achieve? Who is affected in terms of people versus the planet? How much change is occurring as a result of this investment? What's the contribution to the impact from the enterprise as well as from us as investors? And then the 5th dimension is what are the risks that could derail that impact from occurring? And then alongside that, having a theory of change for every investment at both the asset level. So what are the company's activities doing to hopefully achieve the impact? And then what are our activities as investors, i.e. through stewardship or capital provision, doing to achieve the impact? And so it's the output of that assessment and basically how this works in practice. Every week we have an impact research meeting that brings together different asset classes, impact equity, impact fixed income, where we have a discussion and debate on these ideas through this research. And that helps inform sort of what qualifies for the impact universe. And then as that universe is defined, then we look for the best sort of risk-adjusted return ideas that present, try to build a risk-balanced portfolio around those available ideas.
Could you maybe walk me through a little more your end-to-end investment process, starting how you define your investment universe and then how you allocate, and then how do you evaluate additionality and intentionality and measurable outcomes?
So what sits at the very top is our exclusion list. So no matter how compelling a particular bond or issuer might be from a project or UOP perspective, we do have an exclusion list that removes around 15% of the benchmark. So those are going to be in categories that you would not expect to see on an impact strategy, i.e. alcohol, tobacco, weapons, et cetera. So I have 85% of the benchmark that is left available to me. From there, we carry out an alignment screen. So greater than 50% of current revenue alignment that is aligned to environmental or social impact. And there are kind of specific pillars and subpillars that we use to define those alignment categories. Or it's a use of proceeds bond. So once we apply that narrows the universe down a bit to around 30% of that benchmark, 900 or so issuers, and then takes forward the impact materiality assessment, which is the 5 dimensions of impact assessment, and then also an ESG bond evaluation. So the universe gets increasingly more narrow. That's the impact underwriting that's occurring. And it's through those frameworks where we're assessing for things like materiality. So I think the 5 dimensions of impact framework does a good job of assessing how much impact is occurring. And then also through that, you can tease out intentionality. You can have an understanding is this green bond that's being financed aligned with the issuer's enterprise level sustainability strategy? Because that can signify intentionality from the issuer perspective. Measurability, upfront, we have to identify a non-financial KPI that we can attach to every investment. And then we document that, we record it, we track it, we report on it over time to make sure that we're able to capture the measurability piece as well. And then additionality, how I think about that is those 2 concepts that I mentioned earlier around either providing capital in a direct manner that produces measurable impact, or through our stewardship activities and being able to connect those activities to the achievement of an impact. And then after that impact universe is defined, it's kind of just a regular way global credit portfolio management. We look for good fundamental ideas. We build a portfolio through a disciplined risk management framework, importing the best principles of portfolio construction that I took on through my years of managing IG corporate bond portfolios. That feeds through to the final portfolio. And then it becomes an ongoing feedback loop of risk management, measuring impact, and then also reporting impact on a regular cadence to our clients.
You write a lot about additionality, and it's often one of the hardest things to prove. I just want to know a little more how you assess that, this whole concept that the outcome would not have happened without the capital. So how do you evidence that, especially when you're in a liquid public bond strategy and you're often just one of the investors among many?
That's a great question. And I think if you look across public fixed income, there's going to be a range of additionality that an investor could have, right? And so we've been lead investors in a number of the World Bank impact outcome bond transactions, specifically the plastic collection and recycling bond, the Amazon reforestation bond. We're also one of the largest investors in the wildlife conservation bond. I think those bonds are excellent examples of how public fixed income mobilizes capital to projects that otherwise wouldn't get funded without the participation of public fixed income. You can also look at a number of, say, sub-benchmark size public transactions like the Ørsted Blue Bond. That was, I believe it was 100 million euros in size that, again, maybe those projects don't get funded without the participation of public fixed income. So that's more on the capital side. I think one maybe interesting area where we're doing a lot more is on the transaction or deal origination side. So one thing we've been doing more intentionally is identifying way early in the process companies that have scope to issue labeled debt, but maybe haven't done so yet. And then approaching them with this idea of, hey, if you will issue a blue bond that's consistent with our impact framework, that allocates to these specific projects, T. Rowe Price will be an anchor investor. We'll help finance that bond into market. So I think that's a really clear demonstration of additionality where you're working with an issuer in the very early stages, helping to guide them on project eligibility, helping to guide them on measurement, and then ultimately financing that bond into the market.
You've organized your strategies around two impact pillars. The first one is climate and resource impact, and the second one is social equity and quality of life. Walk me through each of these pillars and what kind of issuers and sectors fall into each one, and what are the real world outcomes that you're looking for?
Right. So when we were designing this impact pillar framework, defining the impact pillars and defining what I'll go into in a second are the impact sub-pillars, what we were endeavoring to do is look at activities that were financeable within the bond market and how those activities connected ultimately to the UN Sustainable Development Goals. Because it was really the UN SDGs which informs our intentionality for the issues that we're trying to solve for. So starting at the broadest level, climate and resource impact, that first pillar, which is focused, as the name would suggest, on more environmental solutions. So the first sub-pillar there is reducing greenhouse gases, where that could be renewable energy projects, and how we would measure impact from that would be greenhouse gas emissions avoided. The second sub-pillar would be nurturing circular economies. These would be projects that are helping to move from a linear consumption model to a circular consumption model. It could be things like reduce waste, recycle additional materials, and we've seen these types of projects financed through green bonds. And then also promoting healthy ecosystems. So this is more kind of into nature, biodiversity, water, where the KPIs that we endeavor to report are, cubic meters of water saved or hectares of forests conserved or protected. So those are the sort of broader environmental solutions that we're seeking within that climate and resource impact pillar. The second, which is obviously more socially geared, enabling social equity is the first sub-pillar there. And through these types of activities, we're looking to promote financial inclusion. So it could be a social bond that is lending capital to SMEs and entrepreneurs to help spur job creation. It could be affordable housing that's provided. The second is improving health. So very simply, these would be healthcare companies where hopefully we can measure something like quality of lives extended or number of patients treated to sort of proxy the impact that's being generated from those companies and those projects. And the third one would be improving safety and security. So if a company is providing safety solutions, or if a tech company perhaps is preventing cyber attacks to help save value, that could fall under this improving safety and security sub-pillar.
How do you allocate capital across these two pillars? Are you trying to balance them, or does it completely vary based on opportunity and market conditions?
I try to let the bottoms up dictate more so than having some top-down target for across pillar 1 and 2. That said, our clients hire us for delivering environmental impact and social impact, right? And so I think it's best served in their interest if we can strike some sort of balance between pillars 1 and 2. So if you look back over the history of our portfolios, we've consistently been above 40% or below 60% within each of those two broad pillars, consistent with that spirit.
I'm interested in your perspective on that. In the different discussions I've had on the show here, I've had a number of people say or indicate that climate's become much more investable, and climate's kind of sucking the oxygen out of the room for social equity types of investment. Or what's your view on that?
Certainly through the labeled bond space, that's very true. I mean, green bonds have asserted their dominant position within the labeled bond market. And from the feedback that I hear from issuers and underwriters is that issuers prefer the green bond format because they think the impact is easier to measure. Can't argue with that. I take a little bit of issue with not issuing a social bond because you have a challenging measuring the social impact. It's like to say, don't let perfect be the enemy of the good. So if you can find a good social project, but maybe you struggle to get the right perfect KPI to measure the social impact that's being generated, I don't think that's a reason not to invest. So where we can find social impact in this environment of dominant green bond issuances, say through emerging market financials, right? And we might do this through a labeled bond. We might do this through a non-labeled bond. And through an EM lens, if we can see a bank that's allocating a large percentage of its capital or loan book to SMEs, to microfinance, to entrepreneurs that are helping in turn spur job creation, we think that's a really compelling avenue to get social impact. And then alongside that, I think the healthcare sector is one that also presents compelling through the non-labeled format.
Let's talk about post-investment measurement, about impact, because that's where I think a lot of impact investing falls apart. How do you actually measure the impact of your portfolios? Are there key KPIs that you track? Are they different bonds? I guess the fundamental question is, how do you deploy capital for measurable positive impact without just telling a good story? What does the actual rigorous process look like?
So yeah, as you rightly point out, measurement is a persistent, or it's an evergreen challenge that we have as impact investors. How can we, credibly measure impact? There's no gap for impact measurement, right? Or IFRS for impact measurement that provides a uniform standard for how to do it quote correctly. So there's really, I'd say, 3 sources where we get our impact data. So if it's a labeled bond, it's very simple, right? The issuer provides that impact measurement in a post-issuance allocation report. We look for those reports to be audited by third parties so that there's some degree of assurance that what the issuer is espousing is in fact verified and correct. And we've seen a range of approaches taken by issuers on this front. So we try to be very discerning in how we take in that data and credibility weighted accordingly. But the first and easiest way is when the issuer provides it through the project level. If it's a conventional bond, then we will look to the issuer's sustainability report. We could find often KPIs embedded within those, things like renewable energy generated or greenhouse gas emissions avoided, patients treated, where we can take that KPI from that data source and then input it into our systems. If we don't find it through the issuer sustainability report, we can engage with the issuer to try to get that data. Sometimes that's proven to be successful. If we strike one through the project level data, we strike out again through the issuer provided data, through the sustainability reports, or through engagement. We also work with an outside impact measurement company. And that outside impact measurement company has a global team of measurement analysts. And that's all they do is go through academic research, through NGO research, multilateral development bank research to estimate impact very transparently. You can attribute it. And then we'll take that data in if all else fails, we'll take in that outside impact measurement source to bring it in.
Is that Bluemark, or who is that?
It's actually a company called, we have worked with Bluemark, but the company I mentioned here is Net Purpose. We've been working with them for a number of years.
Where are they based?
I believe in London. Oh. So the core KPIs that we track now, there is an abundance of impact KPIs out there. I mean, I've seen impact reports where we'll see 20 different KPIs. I'm like, okay, well, that's not really helpful. I mean, it's good that you're tracking all this data and reporting it, but what do our investors care about? I think we try to really focus in on what are the KPIs that are most core, most material to the project being financed. So very simply, if it's a green bond, financing renewable energy generation, what I want our clients to see is how much greenhouse gas emissions were avoided as a result of that project. Now, I think brings up another point where the approach to impact measurement has evolved over the years, and even our own process has evolved. I want to be very transparent around how much impact our clients' capital are actually generating. So that's not best served by me going to an impact report and saying, okay, Ørsted's, wind project reduced X number of greenhouse gas emissions. Okay, well, I don't own all of Ørsted. I don't own that entire project, right? And I've seen other managers take this approach. Well, they'll try to, say we have maybe a 5 basis point position in Thermo Fisher. And so let me say that we've treated, 40 million patients or something like that. So what we try to do is hone in on the specific bond financing the specific project and the specific ownership position that we have of that bond. So that when we provide the impact in our impact reports to our clients, they can see per $1 million invested, how much water was saved, how much greenhouse gas emissions were avoided. So to your point, Scott, around sort of calibrating impact per unit of capital, that's how we kind of hone in on that. I think that's the most transparent way. I mean, there's obviously, it's sort of filled with estimations, but we're very transparent about the estimates that we make. But we want to provide that level of clarity and transparency to our clients.
I'd like to understand how you distinguish the difference between impact and ESG integration and sustainable bond investing, because I think these terms get used interchangeably and creates confusion. And how do you distinguish between them?
Yes, this was something we explored quite deeply when, those conversations 5 years ago were happening around, if we're going to develop a strategy, what should it look like? And all of these approaches were on the table. The reason we pursued impact is because I think it's the purest expression of just sort of broadly defined sustainable investing. It's very clear in its intentions, right? It has 2 objectives for measurable impact alongside financial return, and those objectives are co-equal in their pursuit. And then the only other distinguishing, remark I'd make here beyond the other ones which we previously covered is it's focused on the external impact that a company or project has on the planet or society. Contrast that with ESG integration, where ESG analysis tends to look more at the inner ES&G policies and targets that a company might have, and focuses less on what the external impact of that company has on the planet or society. So you can have like a company that scores really well from an ESG perspective, but has no scope to deliver positive impact. I think of like, a luxury apparel company, right? It might score really well from an ESG perspective, but there's no scope for positive social impact from an enterprise like that. ESG integration, as we see it, is a way to really maximize financial returns, right? What are the ES&G factors that are financially material that are going to influence future investment returns in a bond or stock? And making sure those insights are incorporated into price targets, incorporated into credit ratings, and then ultimately incorporated into recommendations, with the objective of providing better financial returns over time. You asked about sustainable investing, and I'm going to give you a bit of a cop-out answer. I'm not sure I can tightly define what sustainable investing is, because I think it means a lot of different things to a lot of different people. Another issue we've seen over the years is there were managers that they just excluded kind of dirty sectors and called it sustainable. I've seen managers have transition strategies and call those sustainable. I've seen label bond strategies called sustainable. So to me, that's a much broader description of kind of maybe a lot of different approaches. And again, kind of one of the reasons we anchored ourselves to impact, because it's very clear in what it's trying to achieve.
Aren't you glad you didn't put ESG in the name of your fund?
Exactly.
I think sustainable maybe has become the catch-all right now. I think there's a lot of ESG funds that have changed their websites to sustainability. And I think already we had a lot of confusion and terminology before, but now we really have it, especially on the US side. It's less so in Europe.
But even then, I mean, if you recall a couple of years ago when we had that wave of Article 9 to 8 downgrades that occurred in the market, and I think this was exactly as you say, these were strategies that were marketed in a certain manner, where the actual investment process underpinning those strategies was something that was not consistent with how they were, quote, named and marketed. And so I think we're still seeing some of that play out.
Could you give me a couple concrete examples, 1 or 2 innovative or high impact transactions that your team has made Because I want to understand what this looks like in practice at the end of the day.
Yep. So I'll give you an example of a blue bond that we helped originate and finance into the market. It was a blue bond issued by DP World. They're one of the world's largest port and logistics companies. And the origin of this transaction actually goes back a little over a year ago. Rowe Price held a Blue Economy event in New York during Climate Week, where we brought together issuers, asset owners, practitioners, academics, and scientists in the field of water finance. And in one of those panels that we were hosting, there was a senior executive from DP World that was presenting the DP World ocean and water strategy. And after the event, that executive came up to Rowe Price team and said, wow, we really kind of like all the work that you guys are doing in blue bonds. I wonder if there's a good alignment to work together on a prospective blue bond transaction. And so following that discussion, our team conveyed suggestions and guidance on how the company could issue a blue bond, the types of projects that they could allocate to. The company took that feedback in for several months. And then December of 24, they came to us and said, okay, we've got this well fleshed out blue finance framework. Thanks for your feedback. We'd like to partner with you on issuing this bond into the marketplace. And so we ended up financing, which was a $100 million blue bond transaction that allocated to 3 project categories. The first was sustainable shipping, so retrofitting their ships to run on biofuels and ultimately reduce greenhouse gas emissions. The second, marine pollution prevention, to clean up the waste and plastic in the waterways around their ports. And then the third was coral reef restoration. And they work with a company here called Coral Vita that provides artificial coral reef restoration, grown in a controlled environment, and then planted in degraded coral reef areas to help improve biodiversity and marine conservation in those areas. So I think that's a really good example of how you can have that additionality, working with the issuer to identify the UOP and then financing that bond in the market. And I think if I could just maybe make one more comment on this, I think this is a good demonstration for, I'd say maybe like the 3 orders of impact or the 3 levels of impact that our clients can have by investing in these strategies. So the first order of impact is very clear, right? Like the bond proceeds go to these projects that produce hopefully good measurable outcomes. The second order of impact is we're also helping to crowd in capital, right? So if we can work with an issuer early on, structure the bond, bring that bond into the market, and maybe T. Rowe Price only owns whatever, 5, 10% of that bond, but we've had an action in bringing that bond to market. We've helped mobilize more investment into those projects and into that bond as a result of it being financed. So we're crowding in capital. I like to think of our clients having, from an impact multiplier perspective, probably 5, 10x of what their capital is doing in terms of crowding and incremental. And then the third order of impact, and I don't think our industry does a good enough job of articulating this, is the on-the-ground innovation that's being funded. So if you take the DP World example, for instance, right, that capital is flowing to that startup, Coral Vita, which is providing a next wave of innovation towards coral reef restoration and promoting ocean health on a much broader scale. So you're actually funding this sort of on-the-ground innovation. And I think that's maybe sometime an overlooked aspect of what these bonds are actually helping to support.
Let's talk about the labeled debt market. You've already mentioned and gave definitions of green bonds and social bonds and sustainability linked bonds and blue bonds. What are the strengths of these labels and what are their limitations?
Right. So just because a bond, is comes with a label doesn't really carry too much weight in our eyes. We've seen examples of companies with really good sustainability stories and targets issuing very poorly structured labeled transactions and vice versa too. So the way that we sort of assess this is we have our own proprietary ESG bond assessment framework, and it looks at sort of 4 pillars of every transaction. We look at the issuer, right? We want to have an understanding of what is the ESG profile of the issuer. Does the company have any net zero targets or climate targets or social targets at an enterprise level that are in alignment with the project that's being financed? So one is having a view on the issuer. The second is looking at the framework itself. Does it have a second party opinion? Is there a governance structure in place to identify eligible projects within the company? It doesn't just sit with the treasurer, but there's actually like a well-formed committee that's making these decisions. And is it aligned with the ICMA principles? We kind of look at those kind of more as checkbox assessments, but we think it's important that the transaction have that. The third, and I would say the most material assessment, comes in through the use of proceeds, right? So we're looking at what projects are being financed and how credible and ambitious are those projects. We have our own internal taxonomy that looks at every single green bond project category, every single social bond project category, and makes a credibility assessment. So if you give an example, if we're looking at a green building, green bond, we'll look at what is the energy certification rating that asset has. Is it, platinum, gold, or silver? To me, that signals some level of ambition. If it's a energy efficiency bond, then we want to have ex ante an expectation that this bond will generate 30% energy efficiency savings over the life of the transaction. So having those sort of assessments and scorecards help us determine that level of ambition. And then the fourth and final is the post-issuance reporting. So here we're looking for, again, KPIs that are core material to the project being financed. We don't need to see 15 KPIs. We just want to see the ones that really matter. We want to see project level reporting, not company level reporting. Again, try to get into very specific the impact that's being generated from our investment. And then we want to see going to new financing as opposed to refinancing old projects. And then lastly, to make sure that that data that's being provided in the post-issuance format is audited by a third party. So that all comes together. There's a rating that is assigned to every labeled bond, green, orange, red, the internal TRO rating. And that green, orange, red rating is a signal for us in terms of whether we should consider that for the portfolios.
At the end of the day, what percentage of your portfolio ends up being labeled versus what you might call conventional bonds, where just the business model itself is impactful?
It's around 60 to 70% will come through the labeled format, and the balance will be through non-labeled. And that is held pretty consistent over the years.
I'd like an example of a time when you passed on a bond because it lacked substance. And then I'd like an example of when you invested in an unlabeled issuer, but you did so because the underlying business was clearly doing something impactful that you could measure.
Sure. We do pass on a lot of transactions, and usually what trips us up is one of two things. It's either where the project itself we feel is not ambitious enough or not credible. And the second would be if there is an issue that we see at the issuer level. So I'm not going to name names, but I can think of an auto OEM company where they've issued actually very well-structured, credible green bonds that kind of pass all our materiality assessments, but we don't buy those bonds because we have issues at the issuer level, a number of ESG and sustainability issues and governance issues that we're not able to get around. And so for us, even though the project itself might be really compelling, we do end up passing on it because of the more issuer level concerns. And then in terms of deals that we have bought that through a non-labeled format, I'll give you an example, XPFR Infrastructure, which is sort of the yield co or development arm within NextEra Energy. NextEra Energy, one of the largest investors for global renewables, has a development business that focuses purely on wind, solar, and battery storage. 100% of the revenues, CapEx, profits, all tied to these renewable energy technologies. And we can measure greenhouse gas emissions avoided as a result of the generation that's being produced by their investments. They just choose not to issue their business through a green bond. But we still think we can find compelling impact, measurable impact through issuers like that.
You've been quite critical of sustainability-linked bonds. What separates a good sustainability-linked structure from a bad one, and what are the red flags?
So many red flags. So the issues that we've seen most prevalent here, it relates to a couple things. One is the sustainability performance targets or KPIs that issuers are selecting are, one, not always core to the business, and two, they're not always ambitious. So when I say core, I've seen examples of energy companies that have issued sustainability linked bonds, but the target has been gender diversity at the board level. Great. I fully support having a gender diverse board. I think that's really important from a governance perspective. That is not the core environmental issue that relates to your business. I would expect to see a target that's more related to, reducing your carbon footprint and having a robust transition strategy in place. And then the second level of ambition, right? And so we've seen examples, and you can search my name and see some of the bonds that have been called out, where the targets that they have been put forward have maybe already been 70% achieved by the time the bond has been issued. And by the way, the baseline that they're using to measure their target was 3 years ago. And actually, even more recently, we've seen targets change after issuance, where the company they'll change the target after the bond has been issued. And then there's really no recourse investors have to litigate or challenge that. So one relates to the targets, and then two relates to the measurement date of those targets. And we've seen examples, and I think this is really just undermines the whole spirit of the label, is when bonds are callable prior to those targets being measured. So the company could be way off target. They're going to pay a coupon step. But you know what? There was a call feature that is in there that lets them call that bond at par prior to that target being measured. So the target's never even measured. So what was the point of doing the label, putting the label in the first place?
You've become a prominent voice on blue bonds and the blue economy. What is the blue economy and why should people care about it? You told us the origin of the emerging market blue economy bond strategy, but why is this a bigger thing?
Yeah. So the origin story is actually maybe even a little bit deeper than I alluded to earlier. So it probably dates back around 2.5 years ago. 2.5 years ago, IFC, which is a member of the World Bank focused on private sector, emerging market, sustainable development, they sent an RFP out to around 15 or 20 asset managers. I have to say, Scott, it was the most interesting, unique RFP I've seen in my career. So typically when we get RFPs in, there's 50, 75 pages long. And on page 63, there's your tracking error budget. Go build us a model portfolio and give us your lowest fee. This RFP was about spotlighting a problem. And that problem being the chronic underfunded nature of the 2 UN Sustainable Development Goals that tie into blue economy. So this is the issue why we should care. So UN SDG 6, clean water and sanitation, UN SDG 14, life below water, are 2 of the least funded of the 17 Sustainable Development Goals. And specifically, life below water is the least funded of the Sustainable Development Goals. So IFC was looking at, okay, how can we engineer an arranged marriage between this very large funding gap and the world's largest securities market in the global bond market? And then, okay, asset managers, go out and figure out a solution for helping to solve this issue. T. Rowe Price was very fortunate enough after a very, very thorough diligence and underwriting process to have our candidacy selected. I think at the conclusion of the IFC's diligence, they knew more about me than my family did. I've had root canals that were less invasive than what they looked up and analyzed and diligenced us against. But we're very fortunate enough to have our candidacy selected at the end of that. And then once we announced our partnership with IFC on effectively launching the world's first emerging market corporate blue bond strategy, that was around 2 years ago, we announced that partnership. There were 2 work streams that kicked off. The first work stream was working with issuers to try to build a supply of emerging market corporate blue bonds that would be financed into the market. So start the engagement with the issuers to get them in place to be able to issue the bonds. And then the second work stream was on the capital raising side. And I can tell you raising capital over the last 2 years in this volatile environment has at times felt like hand-to-hand combat, but we're able to, fortunately, with a couple months ago, announce our $200 million first close in this strategy. And the reason we announced this launch now with that amount of capital secured is we now see this wave of supply, wave pun intended, a wave of supply coming from the blue bond market from emerging markets. And we've sort of seen that actually play out over the last couple months.
These blue bonds are often low BBB emerging market corporates with relatively short durations. That's risky. How do you get comfortable with that risk profile?
So we're very fortunate enough to have a very strong and long tenured record of investing in emerging markets. We've been investing in emerging markets at T. Rowe Price for 40 years. We have an EM debt and equity platform of over 75 billion of AUM, and having that platform of analysts analyzing the fundamentals, analyzing the markets and countries and regimes in which these companies operate in, underwriting them on a hold to maturity basis is really what informs the credit underwriting process for these types of investments. So, not too dissimilar from how we underwrite in our impact strategies is we need to have a good, clear, credible impact thesis, but then also we need to have a robust fundamental thesis that accompanies that.
But bluewashing must be a concern. So how do you decide what's genuinely blue versus what's just marketing hype? What kind of red flags do you look for that make you walk away from a deal?
Yeah, totally. So we designed our internal blue impact framework that we co-developed with IFC. And that blue impact framework outlines the 11 eligible project categories from clean water infrastructure to marine pollution prevention to marine conservation and coral reef restoration. And then within each of those different project categories identifies qualifying criteria. So to your point, Scott, if it's a water efficiency project, we have an expectation that it's going to generate 30% of water efficiency savings. on a per annum basis. If it's a desalination project, we have requirements around how they manage the brine management, how those desal plants are powered from a renewable energy perspective. So those are the qualifying criteria for us. And then we also have impact indicators that we attach to each of those project categories. And we're very happy to socialize this into the market because ultimately we want high credible transactions out there. So we socialize this with issuers, we socialize this with underwriters in hopes that the bonds that ultimately, the blue bonds that are brought in are ultimately done so in a credible manner. And the last thing I'll say here is I think like we're priding ourselves on being an innovator and leader in this space. And being an innovator and being a leader, being a first mover carries responsibility. And I think we have a great degree of responsibility to get this right from an impact perspective. And so that's really what that Blue Impact Framework is meant to do is govern the standards to make sure that what we're doing is done so credibly. And then, sorry, one more thing I'll say is that we've also have a stand-up external advisory committee with external experts that are informing us on best practices in this field.
All right. You've talked about engagement being a core tool for impact for fixed income investors. You don't have voting power like an equity investor does. So how do you measure whether your engagement is actually working?
Correct. We don't have the proxy voting mechanism, but we do have a pretty important supply of capital that companies need in order to finance their businesses on an ongoing manner. So they're constantly coming back to the bond market to finance projects and acquisitions and activities. And I think it's important that they have a good dialogue and in relationship with their debt investors. I have found in my experience that companies are enthusiastic to engage with debt impact investors. And in fact, they often want to hear about how they can improve standards and ambitions because they want to be, they don't want to be accused of greenwashing, right? And so having that open dialogue, I think, is really important to begin with. And so then how we approach it is when we have a conversation with an issuer, an engagement with an issuer, we upload it into our internal research system. We know what type of engagement it was, what topics did we discuss, and then what targets did we set forth and communicate to the issuer, and then have those targets be time bound. So when we come back 12, 24 months later, we can revisit to see whether those targets were achieved or whether, if not, then do they need to be escalated? Causality, tough to prove causality between a conversation and an outcome, but I do feel like we have to do our part. And I think that's the best we can do is to have those transparent dialogues and track them and escalate as needed.
Can you give me a specific example where your feedback changed an issuer's behavior, where you can point to something and say, well, that wouldn't have happened without us? And were you the only one engaging, or were you part of a mob?
Right. So, I mean, when we do engage, we're typically doing it in a bilateral capacity. So it's typically just us and the issuer. So it's a very kind of one-on-one type of relationship and discussion. One example that comes to mind is Ørsted, when they issued their euro-denominated blue bond a couple of years ago and marketed that deal to investors. It was predominantly done with the expectation that proceeds would be allocated towards offshore wind, which is obviously very core to their business. We made an engagement request with them that they actually allocate a majority of those proceeds into more SDG 14 type projects, right? Because we think financing SDG 14 is really important and it's hard to find in the bond market, candidly. So they ended up allocating a good bit of their projects to things like coral reef restoration and marine biodiversity and conservation. And I would like to think that our engagement played some maybe small part in that outcome, but that was the sequencing of events, and it turned out in a manner that we had hoped and asked for.
Your strategies are classified as Article 9 under SFDR, which is the Sustainable Finance Disclosure Regulation, which is the strictest sustainable investment category in Europe. How has that designation shaped how you design and run these strategies?
So yes, correct. For both our European retail strategies carry an Article 9 designation. I'd also add our UK retail strategy carries an impact label. And I think we're one of a small handful, maybe 3 fixed income funds in the UK retail market that carries an impact label from the FCA. And really what that means in terms of how we manage our strategy, it doesn't really change. Those labels don't really change the substance or process of what we're doing. What we were doing was occurring prior to applying for those labels. But I would say one very discerning characteristic of what was required to carry an impact label through the FCA was a very clear understanding of what our investor contribution is. So I think this is a distinguishing characteristic where every investment ex ante, we need to identify how are we contributing to the specific outcome in a measurable capacity. And we've talked about some of the ways that we do that. I actually think SFDR, maybe even a little bit lighter touch than what the impact label otherwise denotes within the UK market, where that's, I think, more focused on qualifying sustainable investments and managing negative risk through do no significant harm and good governance.
When you're sitting across from a skeptical CIO who's fed up with greenwashing and ESG marketing hype, what do you say to convince them that this is different? What's your pitch?
So I think the deal origination is a really important differentiator for us. We've helped bring 4 blue bonds to market over the last year, and I can credibly track our activities pre-issuance, time of issuance, and then financing those bonds into issuance. So actually having that measure of additionality, we're not just passively waiting for bonds to be financed in the market. We're proactively identifying prospective transactions and help bringing them to. And then I can point to some of the external data points, right? So I mentioned the impact label from FCA. We've undergone a verification through Bluemark, which assessed us against the operating principles of impact management. And how we score there is on our website, and an investor can see very transparently where our strengths are. There's a couple funds category, or a couple of awards that we've won, our funds have won over the years, from best impact fund to best sustainable bond fund. So I can point to some of those external validating points if everything I say doesn't otherwise convince them.
But tell me, what's the biggest lie being told in sustainable finance right now?
Good question. I think the biggest lie being told is espousing additionality when perhaps it's not there, or espousing a contribution when it's not there. And to your point earlier, Scott, around secondary bond trading, buying the secondary market, these are some of the concepts that I candidly struggle to link credibly with impact and additionality. And I think maybe we just take a more of a purist point of view on this than others might. But I do think that maybe a concept of additionality has been diluted a little bit and maybe is played up a little bit in the market more so than it actually should be.
What interests me in what you're doing is the potential for scale. If we can agree that we're really achieving impact, where do you see the most opportunity for scaling credible outcome-based impact in the mainstream credit markets?
So we're very bullish on the prospect of blue bonds being more mainstream. Mm-hmm. So if you look at the green bond market, 70% of the proceeds go to 3 categories: green buildings, renewable energy, and energy efficiency. Blue is incredibly underfunded. We look at the blue bond market today and we would say it's at a similar place to where green bonds were 10 to 15 years ago. I think they're at I would say a tipping point today. And I would say that for 3 reasons. The first is that now public policy is a tailwind towards water finance. So I think it was 3 years ago, water was firstly and formally put on the agenda at COP. So that tends to mobilize public sector investment, and how we see these markets form over time. We saw it with COP 21 and Paris Agreement, where that mobilized a lot of capital into green and environmental solutions in the public sector that eventually fed through to private sector. I think we're at a similar tipping point today in public sector finance supporting ocean and water related projects that hopefully will eventually feed through to private sector and ultimately the bond market and mainstream finance. The second reason is that water is one of those uniquely unifying sustainability themes, right? I mean, we haven't talked politics here, and I don't really want to talk politics here, but for all the politicization of ESG, water is one of those topics that I haven't met anyone that's against having clean drinking water or clean oceans. And I imagine if you polled a lot of your previous guests on this podcast, they might have different views on environmental priorities or social priorities, but I'm betting nobody would be against having those clean water and clean oceans. And then the third, and this is just a concept that I've seen percolate and surface in the bond market, is a desire to have more thematic type issuance. And I think Blue is one of those thematic type issuance programs that tends to resonate really well across the broader finance ecosystem, from issuers to underwriters to investors. I think there just seems to be a real sort of genuine enthusiasm and support for financing this what's previously been a very underfunded project category.
Are blue bond projects always in emerging markets?
No, I mean, we've seen blue bonds issued by sovereigns. We've seen blue bonds issued by developed market utilities out of France. Debt has issued a blue bond, and we've also seen the multilateral development banks issue blue bonds as well.
If we jump forward to 2030, what does impact fixed income look like? Is it still a niche, or has it become mainstream?
I think that will depend on what returns we can deliver from now until then. I think the accountability and responsibility sits with the managers to show proof of concept and to provide a market rate or better return to our clients. If we fail to do that, then impact will never scale, because you cannot, I can tell you all these great stories in the world, right, Scott, about we own this bond and that bond, but ultimately, if we're not beating our benchmark and we're not providing a competitive return to our clients, then I don't think we earn a right to exist. And so from now to 2030, if we've proven that we can deliver that market rate or better return, and we can and we have, and I know many of my peers have done the same, then to me, impact should be an allocation that sits within a broader asset allocation portfolio construct, right? So maybe you have your core bond, you've got your core equity, and then, if you have a sustainable objective at an enterprise level, you should have some sort of impact allocation. If that plays out, there's no reason this can't be a, multi-trillion-dollar market in time.
What's the most controversial opinion you hold about impact investing that most of your peers would disagree with?
I'm a big believer in not letting perfect be the enemy of the good. And what I mean by that is I have seen transactions that have been marketed to investors where, man, the credibility of the project is strong and the issuer is sound and the KPIs are there. But you know what? Maybe they didn't tick a box. Maybe their refinancing look back was 36 months instead of 12 months. Yeah. Or, maybe they didn't get a second party opinion. So because they didn't check one box, some investors just wholesale won't buy that bond. I disagree with that. I think you should be looking more at the substance of the projects that are being financed. Do your own work, do your own diligence. And if you know and can credibly underwrite there's some good happening from this project, the planet or society is better off as a result of this transaction, then I think it's worthwhile of our investment. I'm not in the box ticking exercise. I'm more of looking at the substance and credibility of the underlying.
If you could go back and give the younger Matt Lawton one warning before he launches his first impact fund, what would you tell him?
Every single position will be scrutinized. I learned this lesson very early. I think we launched our strategy in December of 2021. I think in January of 2022, woke up one morning to an inbox full of all of these questions, not even from a client, from a prospective client that had looked at our portfolio holdings and wanted to know, why did we own company A, B, and C? What engagements have we done with them? What KPIs are we using? And of course, we had credible answers to all of that, but I did not expect that level of scrutinization to occur on such a micro level. So I don't think I would have changed anything, but I maybe would have liked to have had a little bit of a heads up that's what we were signing up for.
Matt, I've got a few last rapid fire questions to wrap up our talk here. So just give me whatever comes to your mind, or if nothing does, feel free to take a pass. That's okay too. But if you had to name the single most important challenge in the impact fixed income investing space at this time, what would it be and why?
So I think, what I would say earlier, what I said earlier certainly holds here, and i.e., investors in the investment community, not letting perfect be the enemy of the good. So I think having that mindset is really important. That's a challenge that I think we as a broader impact investment community need to get past. On a more practical level, a really prevalent challenge that we're all contending with is the lack of US dollar denominated labeled bond supply coming into the market. That segment of the market has all but dried up for various number of reasons, which we don't need to get into, but that I think necessitates that investors think more creatively about how they can find the right sector, currency, country exposure within their portfolios. And I think that, for me at least, underscores the importance of going beyond just labeled bonds to build impact portfolio.
What do you know now about impact fixed income investing that you wish you would have known when you first launched the global impact credit strategy in 2021?
So it's just that every bond, every story is going to be challenged. Every client is going to come in with a point of view on the sustainability credentials of a given project or investment. I found in my fundamental investing career that clients were fairly deferential when it comes to single name company analysis, right? They know we have a large credit team and a large equity team that looks at this stuff all day and all night. But when you're talking with a client on sustainability and impact, they're going to have a point of view. And so I have to just make sure that I have conviction and a thesis in everything that we own. And I know that I'm going to be challenged, but that's okay.
Okay. You don't have to name names, but can you describe an example of a bond that you were convinced of at the time you invested, that it ticked all your impact boxes, but in the end it didn't turn out? And what was the lesson learned from that experience?
Fortunately, there aren't too many examples that track this sequence, but one that does come to mind, I know I won't name names. I don't need any more enemies out there, but I can think of one U.S. real estate investment trust that issued a green bond. And in their marketing and in their sustainable finance framework, they espoused that this project would be allocated towards high energy efficient green buildings. When we got the impact report after the bond was partially allocated, we saw that the projects that were being financed were Silver LEED certified, so sort of low level energy efficient buildings. So we had an engagement with the CFO and sustainability team on this issue. What I like to do in these situations is peer pressure, apply peer pressure. If I can say like, here are your 3 peers that are doing this and doing it better than you should do the same. So that's what we did in that engagement. And then they ended up coming back to the market to issue their second post-issuance allocation report. No improvement. And so we had a second follow-up engagement with them and just ultimately realized that we were not in alignment. There was not a strong presence of intentionality from the issuer. So we ultimately had to divest from that security. But to your point, lessons learned, right? So what did we learn from that lesson? A lot more proactive about communicating where we want proceeds allocated ex ante. So whether that's in the pre-deal marketing or at the time of the roadshow, just being very clear about where you would like to see proceeds allocated as opposed to responding after the fact.
Now, the converse of that, can you describe a bond that you were skeptical of, either at the time you invested or maybe you passed on it and walked away, and in the end it turned out way better than you thought, and you were pleased you invested, or if you had passed on it, you wished you hadn't? And what was the lesson learned from that experience?
Yeah, I wouldn't say this was one where we had skepticism, but a bond that I will mention by name because I think it's a good story is Sabesp, which is a Brazilian utility, and they issued a blue bond earlier this year. We had been working with them for a number of months on structuring that bond. And when I was underwriting that bond, it was kind of like a clean water and sanitation SDG 6 type investment, right? And so what I think I'm getting for our clients in that investment is, it's the company's providing a basic social good to its residents and its population and service territory. What I didn't really appreciate was all of the co-benefits that are presenting as a result of that investment. So particularly with Brazil, 350,000 hospitalizations in the country due to poorly managed sanitation and poor drinking water. 12,000 deaths occurred as a result of poorly managed sanitation. And 8.5% of those occur in the state of Sao Paulo, which is where Sabesp operates. So I think having a better appreciation for the healthcare co-benefits that present. And then I'd also mention biodiversity as well. Like when we were buying this bond, I don't think we had an appreciation for the biodiverse impacts that are being generated. And we had an analyst in Brazil earlier this year that was looking at one of these sanitation facilities and a specific riverbank that was adjacent to these facilities where 5 years ago would have been a health hazard to be around. But because of the infrastructure investment that this company had put in, there's now shoals of whiting, there's seahorse thriving, there's people bathing in these riverbanks. So I think having an appreciation for some of the broader co-benefits that present beyond the obvious, I think has helped open our eyes to maybe looking a little bit more broader beyond just, okay, this label is providing this impact.
And if someone wants to get into the impact fixed income sustainable bond investing space, how would you advise them to get into that business? Like, what's the best place for them to cut their teeth?
Most of the recent entrants that I've seen come into the space are coming in with a background in impact or sustainability. And there's a lot of good programs out there to come up the learning curve, whether it's through CFA or ICMA training programs. And I think that's all well and good. I think ultimately what determines success or failure as an impact or sustainable investor, though, yes, you have to do the impact bit well, but ultimately you need to deliver compelling financial returns. So I would say get the grounding in the fundamental credit research, get the grounding in the top-down portfolio management, because ultimately, at the end of the day, what we have to manage is individual credit risk. We have to manage top-down macro risk. If we fail to do that, we don't deserve the right to exist, right? And so I think I would actually counsel anyone who has interest to get that core competency in credit underwriting or equity investing first, and then you can marry that with a passion for impact and sustainability.
Right. Yeah. Not having a sustainable business financially is not sustainable finance.
Exactly.
Well, Matt, you've been generous with your time today. I really enjoyed it. And I absolutely love the work you're doing. Like I've said earlier, based on the size of the fixed income market, which is the 800-pound gorilla in the room. It's people like you are working to prove that you can achieve real measurable impact at scale in these mainstream credit markets without sacrificing performance are often the lonely cowboys who are the unsung heroes of impact out there. So thanks again for taking the time to talk about all this with me today. I really learned a lot.
Thanks, Scott. Really appreciate the conversation.
Now tell everyone about your website and your social media and where people can find out about all the great stuff you guys are doing at T. Rowe Price.
Sure. So you can find more about our company on troweprice.com. And then within there, you can go through the various links to see what we're doing in the ESG, sustainability, and impact space. And then on a personal connection level, I'm on LinkedIn, Matt Lawton. You can find me on LinkedIn. That's probably the easiest way to connect with me and everything I'm doing in the impact space.
And Lawton is Lawton. And Matt with 2 T's. Okay, everybody go to troweprice.com. And is it easy for them to find the impact part on there?
I think if you go through capabilities and ESG, you'll find us somewhere buried within those websites. And you can see all the thought pieces we do. There's a number of videos there that we've recorded to just talk about some of the transactions that we've done. And there's a lot of good content on there for consumption.
All right. We'll have show notes on everything we've talked about and links galore at sri360.com. Okay, Matt, thanks again.
Thank you, Scott.
All right. Goodbye, everybody.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.